Spot gold is ticking precisely at $5,196.09, showing a marginal, almost insulting 0.36% drift upward, while spot silver sits at $90.07, flashing a highly deceptive intraday gain of 3.39%. This is the exact trap that liquidates accounts. Retail traders stare at that green percentage on silver and feel the dopamine rush of a breakout, completely blind to the catastrophic 23.92% bleed it has suffered over the last 30 days. They forgot that just 6 months ago, this asset surged an unprecedented 122.99%, trapping late buyers at historic highs. Now, look at the microscopic structural details of the overnight Asian session. What the untrained amateur eye perceives as a boring, slow, or sideways market is, in reality, a highly calculated clinical liquidity build phase, meticulously orchestrated by institutional algorithms. We are witnessing absolute textbook range compression. When an asset with the historical volatility of silver suddenly flatlines overnight after a brutal monthly drawdown, a volatility squeeze is not just possible, it is mathematically imminent. Market makers are intentionally suppressing price action right now, laying down a perfectly flat horizontal channel to entice impatient, undercapitalized retail traders into taking early, poorly funded positions. They are constructing an artificial ceiling of perceived resistance and a manufactured floor of perceived support, entirely for the purpose of retail baiting. The current stillness you see on this chart isn't peaceful. It is a pressurized vacuum, a coiled spring waiting to snap. The longer this compression phase drags on, the more violent and unforgiving the eventual expansion will be. If you're sitting in a long or short position right now, feeling comfortable simply because the price isn't moving against you yet, you have already lost. You're not a trader in this scenario. You are the targeted liquidity. Perform a forensic autopsy on this specific pre-London setup, and the underlying institutional intent becomes glaringly, almost offensively obvious. We are not drawing arbitrary lines on a chart and hoping for support or resistance to hold. We are hunting for algorithmic liquidity pools. Just below the established Asian session lows sits a massive, unprotected cluster of sell-side liquidity. This is exactly where thousands of retail longs have lazily dragged their trailing stop losses, desperately hoping to ride silver's minuscule daily momentum back to the highs. You must understand that institutions do not buy at market price like you do. They engineer price action directly into these exact liquidity pools to execute their massive multi-billion-dollar block orders without experiencing catastrophic slippage. Look closely at the H4 candle closures from the overnight data. They are repeatedly leaving long lower wicks, yet the candle bodies are aggressively failing to break market structure to the upside. This is a dead giveaway. It indicates that while the algorithms are passively accumulating, they are actively suppressing the markup phase. Furthermore, there is an unmitigated, highly concentrated bearish order block sitting just above the current price action, left behind from yesterday's New York session close. The market is drawn to this imbalance like a magnet. It must revisit and fill this void. The institutional blueprint is set in stone for the morning. Intentionally trigger those retail stop losses to absorb the resulting wave of panic selling, accumulate those long positions at a heavy discount, and then violently reprice the asset higher directly into those unmitigated supply zones. If you cannot visualize this architecture forming in real time, you are flying entirely blind in an apex predator environment. As the London session officially comes online and volume floods the network, the level 2 data and live order flow are printing a very specific, highly dangerous narrative. The tape is currently displaying heavy, synchronized algorithmic spoofing on the ask side for gold, situated just below the psychological $5,200 threshold. These aren't real sellers. They are flashing a massive, intimidating sell walls, pulling them offline milliseconds before actual execution, and systematically replacing them higher up the ladder. This tactic is exclusively designed to artificially suppress the bid and systematically force weak, overleveraged hands to capitulate early. Conversely, when we drill down to the 5-minute microscopic tape for silver at the $90.07 node, we are observing glaring, undeniable delta divergence. The raw price action is grinding marginally higher, painting a bullish picture, yet the cumulative volume delta is aggressively shifting negative. What does that actually mean for your account? It means the true smart money is actively hitting the bid and silently offloading their massive inventory directly into the blind retail buying pressure. They are effectively capping the upside potential while perfectly masking their distribution phase. They are stress testing the depth of the market, measuring exactly how much blind buying power is left in the retail sector before they pull the rug entirely. Order flow dictates that when the bids finally stop stacking and the retail momentum inevitably exhausts itself, the trap will spring shut with terrifying speed. The tape does not lie, it does not guess, and right now it is screaming that a violent account-wiping repricing event is being precisely calibrated behind the scenes. Navigating and surviving this specific environment requires a ruthless, entirely binary trading directive for the next 4 hours. There is absolutely zero room for hesitation, emotion, or gut feelings. We are operating exclusively on strict conditional parameters derived directly from the live data nodes on the screen. Scenario A: if spot gold initiates a rapid, aggressive sweep of the overnight liquidity pool down to the precise $5,180 node and instantly rejects that level with a massive, undeniable spike in tick volume, we have our definitive confirmation of institutional absorption. Upon the 15-minute candle, strictly closing its body, back inside the previous established range, we immediately initiate aggressive long positions. You must fundamentally understand this psychological reality. The initial directional move you are about to witness in the upcoming London session is highly likely to be a meticulously engineered fake-out. London market makers are notorious for creating the initial trap, building a highly convincing but entirely false narrative that the New York session will then violently dismantle a few hours later. If London aggressively runs the price up right out of the gate, it is usually designed solely to price the asset at an extreme premium so that New York banks can short it into oblivion. Even if you somehow survive the London manipulation phase, you still have to navigate the sheer, unadulterated volatility of the US session, where the actual dominant volume enters and the true institutional intent for the daily candle will finally be revealed. Make no mistake, this market is a zero-sum game. For you to walk away with profit, someone else's account must bleed. The algorithms operating on the other side of your screen do not feel fatigue, they do not feel fear, and they are immune to greed. They are cold, calculating lines of code explicitly designed to exploit your inherent human psychology and drain your margin. You need absolute, unwavering discipline and a master-level understanding of market mechanics to survive the coming sessions. The raw data is laid out perfectly before you. The liquidity traps are fully primed. The only remaining question is whether you will be the one mathematically executing the trap, or the retail liquidity caught dying inside it.